stocks, ETPs, otherwise known as ETFs, that just is short for exchange traded product. The most commonly known vernacular terms would be exchange traded funds. One of the most popular option contracts that is traded, and the most liquid option contract, is the SPY, the S&P 500 index, which is the ETF that tracks the S&P 500 index. Then you got indexes, currencies, commodities. We're just going to focus on stock today. That's really all that we're going to look at, because I don't want to make it too complex here. What price are we agreeing on? Well, they call that the strike price. So this is the price per share that the transaction would occur if the buyer exercised their right embedded in the body of the contract. And then what time frame? Time is money. You have more time. If you buy a 6-month insurance policy, that's going to cost you less than a 1-year insurance policy on your car insurance. And it's also very true in the options trading world. Normally on Fridays, most option contracts will expire on a Friday. Nowadays, though, they have a whole lot of different expirations. They have, if you go to the major indexes that trade options, a lot of them have an expiration that happens every single day of the week, Monday, Tuesday, Wednesday, Thursday. But normally on Fridays, and especially if you're just trading common stock. All right, so the quantity in our instance, we're just talking about one. So you're buying one contract that would represent 100 shares of stock. It would give you the right to buy or sell 100 shares of stock because we only trade one contract. What's the product? We're a fictitious company, ABC. What price are we agreeing on? In our example here, we're going to have a $1 strike price. And then we're going to go and look at the time frame. Now, I needed to change that back, but in our example, it's March 15th, which is 50 days away, which at this point in time would be December 27th. I changed it, forgot to go back and change it to March, only to fit along with the examples. This is the only spot I did that, though. So there's my little disclaimer on that. So the anatomy of an option contract. What quantity are we agreeing on? Well, one, and that represents 100 shares. What product are we agreeing on? ABC stock. What price, called the strike price, is going to be $100. And what time frame? March 15th, 50 days away, expiring on March 15th. So now what are you going to buy? What type? Are you going to buy a call option? Are you going to buy a put option? Call option is the right to buy, the right to call stock away from you. Put option is the right to sell, the right to put stock to somebody. Now, we get into the tricky part of the options trading world. So, if once you purchase this option contract and say you are the owner, another term that we will use, you would be considered long that contract in your account. I'm going to buy that option contract, and then once it's in my account, I'm considered long. That means I own that option contract. Now, there are 3 different things that I can do with it once I own that. I can exercise that right embedded in the body of that option contract. I can let it expire. I can say, all right, I don't want to exercise that right. In other words, there's no benefit to doing that. The market went the wrong direction. And if it does expire, well, whatever you paid for that option contract is going to be your total risk, and that would be the cost.